Hello and welcome to this webinar for National Standard Setters. In the next hour, we will be introducing the request for information on the post-implementation reviews of IFRS 10, Consolidated Financial Statements, IFRS 11, Joint Arrangements, and IFRS 12, Disclosure of Interest in Other Entities. So let me start by first apologising for the technical problems we had last week when we tried to run this webinar. I really hope that those won't reappear today and that you get the most from this webinar. I also want to let you know that we can make the slides available for this webinar to yourself in PowerPoint form. So if you would like copies of the slides, do contact the project team and we will be able to send you a copy of the slides. And before I hand over to the team, I'd also like to note that in responding to the questions and the comments we make during this webinar, this will not necessarily reflect the views of the board or of the IFRS Foundation, but the views of those participants taking place. So with that, I'd like to introduce Mary Toker and the members of the project team who led the work to develop the request for information. Mary and the project team will be providing an overview of the request for information, after which we will be opening up the meeting for discussion. We already have one question submitted, so please do feel to add questions into the question box. Our aim of this webinar is to explain the content of the request for information to assist you as national standard setters and regional bodies in your outreach activities in your own local jurisdiction with your stakeholders. We hope that this will help you in responding to the request for information and enable effective technical discussions on the topics in the consultation. And so with that, I will hand over to Mary Toker, our board member. Thank you very much.
Okay. Michelle, thank you for that introduction, and thank you to everybody who has had faith and confidence and joined a second time. Let me add my apologies to Michelle's for the difficulty we had last week. And then I'm going to start with one of those personal remark type items that Michelle mentioned. And it's a caution to us all to be careful what you wish for. And I say this because the first phase of our work on the post-implementation review, which I will shorthand as PIR, identified a number of areas for which additional guidance was requested. I can understand that if you're dealing with one of the situations described, it can be challenging, it can be frustrating, it can be time-consuming to resolve the issue. But if an analysis depends very much on specific facts and circumstances and or the situation occurs only infrequently, then additional guidance could to have us add additional guidance could greatly increase the complexity of IFRS standards for everyone who has to use the standards while benefiting relatively few. So therefore, in order to help the board assess those requests for more guidance, you'll see a number of questions in the RFI, the request for information, that focuses on the topics for which more guidance was requested. And what we're asking in the RFI is for more information about the frequency and the severity, the significance of the impact of those issues on financial statements. So with that observation to start us out, let's look at the agenda for today. And I'm going to start by talking a bit about post-implementation reviews in general before handing over to Filippo in the first instance to drill down a bit more on the RFI. And we've done this presentation to support the RFI, which was published in December, and it's in relation to the post-implementation reviews of the three standards that we have on group accounting: IFRS 10, Consolidated Financial Statements; IFRS 11, Joint Arrangements; and IFRS 12, Disclosure of Interest in Other Entities. As I said, the first thing I'm going to start with, and you'll see this on slide 3, is just a general discussion of a post-implementation review, because we thought it might be helpful if we recapped what a PIR is and what its objectives are. So a PIR is part of the board's due process, and it aims to help the board assess the effects of our requirements on users of financial statements, preparers, auditors of financial statements, and others, for example, regulators. In particular, the board aims to assess whether a standard has improved financial reporting without disproportionate cost, and also to identify lessons that may help us improve future standard setting in other areas. So in the context of a PIR, the board tries to assess whether the objectives of the standard setting project have been met, whether information provided by the standard is useful to users of financial statements, whether the cost for preparing, auditing, enforcing, and using the information provided in response to the standard's requirements are broadly as expected by the board when it developed the standard, and whether the requirements are capable of being applied consistently. In summary, and in my own words, basically a PIR is about whether actual equals expected, and if not, whether any follow-up is necessary in either the short or the longer term. Okay. Now, the next slide, slide 4, gives us a bit more information about how a PIR is conducted. And we conducted this one in 2 phases. In the first phase, the board identified and assessed matters to be examined further in the request for information. We identified matters for further examination using the following criteria. First, the importance of the matter to those who raised it, including whether financial statements faithfully portray the reporting entity's financial position and performance, and whether the requirements result in reporting entities providing financial information that is useful in making informed economic decisions. And for those of you who marched through the conceptual framework project with us, you'll recognize a lot of those benchmarks from the CF. The second thing we're trying to understand, so the second criterion is how application challenges affect the consistent application of, in this case, IFRS 10, 11, and 12. And then third, the importance of the matter or matters raised relative to the objectives of or main changes introduced by the standards that we are studying. So having considered those matters, we developed the request for information, and then in the second, and have published that. And then in the second phase, what we'll do is consider responses to that request for information, feedback from outreach activities, and reviews of the relevant research about the effect on financial reporting of these standards. After we've completed the deliberations in the second phase, we will summarize our findings and identify what steps, if any, it could take as a result of the review. We could decide to add a standard setting project to our agenda. We could consider one or more further matters as part of our research program. We could do some combination of that. We could decide to take no action, at least in the near term, and considering other priorities for our work. So how will we make that decision? Well, we'll make it after we have developed our feedback statement, but some of the things that we will assess include, first, whether the reporting of specified transactions or activities is deficient. Second, the importance of the matter under review to users of financial statements. Third, the types of entities likely to be affected. And fourth, whether the matters raised by respondents are pervasive or acute. I think I used the word severe before. And so, having talked about PIRs in general, we thought that it would be useful as a next step before diving into the specifics of the request for information to review the specific issues. We thought it would be helpful to review the objectives of the project that resulted in 10, 11, and 12. And being an accountant of long standing, I'm going to, in a very unimaginative way, go through them in numerical sequence. Let me start with IFRS 10. The board's objective in developing IFRS 10 was to develop a single basis for consolidation with robust guidance for applying that basis to situations in which it proved difficult for an entity to assess control, including for special purpose entities. Subsequently, the board also introduced an exception for investment entities to measure most subsidiaries at fair value P&L rather than consolidate them. IFRS 11, Joint Arrangements, establishes principles for financial reporting by entities that have an interest in arrangements that are controlled jointly. The classification of joint arrangements depends on the rights and obligations of the parties. That is, an investor that is a party to a joint arrangement determines whether the arrangement is a joint venture or a joint operation by assessing the rights and obligations of the parties to the arrangement. IFRS 11 also addressed weaknesses identified with its predecessor standards, including the accounting policy choice for interest in jointly controlled entities. IFRS 12, Disclosure of Interest in Other Entities, focuses on disclosures intended to enable users of financial statements to evaluate the nature of and risks associated with an investor's interest in other entities. The importance of understanding this type of information was heightened by the financial crisis, which highlighted exposures from involvement with structured entities. Okay, now that we have provided the background to PIRs generally and the board's objectives when setting IFRS 10, 11, and 12, we're finally going to move to the matters that the board is examining further in the request for information based on its findings from its first phase of research. And for this, I hand over to Filippo. Filippo, over to you. I see that Filippo has sent a message saying he's just been kicked out of the audio bridge. We are not without technical difficulties this time. Michelle, would you like me to continue until we hear back from Filippo that he's rejoined?
Yeah, that would be good. If you're okay, Mary, that would be good. Thank you very much.
I might panic a little, but since you can't see my face, it might not be as immediately obvious. So let's start with going back to IFRS 10 and the issue of power over an investee. What are the relevant activities? IFRS 10 requires an investor to consolidate an investee that it controls. An investor controls an investee if and only if the investor has all of the following: power over the investee, exposure or rights to variable returns from its involvement with the investee, and the ability to use its power over the investee to affect the amount of the investor's returns. Filippo, I see you're back. Should I just finish the comments on this slide and then I'll turn it over to you when we go to slide 9? The first topic that we addressed in the RFI relates to feedback received regarding whether an investor has power over the investee. IFRS 10 states that an investor has power over an investee when the investor has existing rights that give it the current ability to direct the relevant activities, and those are the activities that significantly affect the investee's returns. We received some feedback that it can be challenging on occasion to identify what are the relevant activities. This challenge can arise when two or more investors each have rights that give them the unilateral ability to direct different activities. This challenge can be greater if the relevant activities occur at different times or are conditional on future events. One example explained to the staff was a pharma company in which one investor has power over the research and development of a new drug and another investor has power over the marketing and manufacturing and marketing activities. So Filippo, if you're back, I will hand over to you to cover the question that we're asking in the RFI in slide 9. And since I'm not hearing, since I'm not hearing you, I will go on with the slide 9 in the request for information. As you can see, and this is a summary of the more detailed question that's in the RFI itself, we're asking for information about situations in which it is challenging to apply the requirements to identify the relevant activities. And so that's the first question in the background to the first question in the RFI. So we've now handily been moved on to slide 10. And I'll tell you what, Filippo, I will keep going here. If you want to see if you can resurrect your ability to speak into the group, that would be great. And just let us know when you're back. The next slide, and we're still in IFRS 10, gives us background about power over an investee and rights that give an investor power. IFRS 10 makes a distinction between rights that give an investor power over an investee and rights that are only protective. That is, rights designed only to protect the interest of the holder. In addition, rights that give an investor power must be substantive. That is, the holder must have the practical ability to exercise them. In the first phase of the project, some stakeholders said it can be challenging to determine whether rights give an investor power or are protective. The examples provided by stakeholders of challenges when assessing if rights are protective included, first, rights held by a franchisor under a franchise agreement that restrict the ability of a party other than the franchisor to direct relevant activities. The second example is rights to approve changes to the annual budget or major expenditures. The third example of a challenge when assessing if rights are substantive are the rights that become exercisable if the investee becomes insolvent. Additionally, some stakeholders asked for additional guidance, hear that phrase, on reassessing its own rights and the rights of other parties, including potential voting rights, when facts and circumstances change, for example, for changes in market conditions. We also received requests to clarify how changes in market conditions affect the assessment of whether potential voting rights are substantive. The board noted in the basis for conclusions on IFRS 10 that a change in market conditions alone would not typically result in a change in the consolidation conclusion. So that brings us to slide 11, which again summarizes the relevant questions in the RFI, where we are asking for information about situations in which it is challenging to apply the requirements to assess if rights are protective or if rights, including potential voting rights, are or have ceased to be substantive. Okay. I know I have a volunteer to pick up if we can't get Filippo back in at a few slides on. So let me just pause for a moment. Filippo, do you want to try one more time to see if we can hear you? And since we can't, you'll get more of me, and we'll look at slide 12, which again, we're still in IFRS 10, and we're looking at the issue of power over an investee, control without the majority of voting rights. So IFRS 10 refers to situations in which an investor who has less than a majority of voting rights and no other legal or contractual rights has the practical ability to direct an investee's relevant activities because of the size of its own holdings of voting rights relative to the size and to the dispersion of other voting holdings. In the first phase, we heard from some stakeholders that determining if an investor has control without having the majority of voting rights is challenging in some situations and can lead to inconsistent outcomes. Furthermore, the reassessment obliges an investor to monitor transactions or events between other stakeholders, and that such monitoring can be burdensome. As background for you, when developing IFRS 10, the board decided that first, that there are circumstances in which an investor controls an investee without having an unassailable legal or contractual right to direct the activities of the investee. Second, that the board should avoid requirements that are based on specified quantitative thresholds. And third, in light of that decision, that it would not be possible to develop reconsideration criteria that would cover all situations in which an investor acquires or loses control over an investee. So once again, we have a question in the RFI that's summarized on this slide. And the questions in this area are focused on understanding the frequency and the severity of the issue. Therefore, we're asking how often an investor is asked to apply the requirements to assess control in situations in which it does not have the majority of voting rights, and how costly it is to obtain the information. Okay, now let's go on to slide 14. And again, still in IFRS 10, we're looking at the link between power and returns, and in particular, the issue of principal or agent. The definition of control has three elements. One, power over the investee. Two, exposure or rights to variable returns. And three, the ability of an investor to use its power to affect the amount of the investor's returns. Let's focus in on this third element of the definition. It requires an investor to be able to use its power over an investee to affect its returns from involvement with the investee. A party that acts as an agent on behalf of another party must act to maximize the benefits of its principal and is therefore unable to use its power for its own benefit. IFRS 10 requires a decision maker to consider the overall relationship between itself, the investee being managed, and other parties involved with the investee, and to consider the following factors in determining whether it is an agent. One, the scope of its decision-making authority over the investee. Two, the rights held by other parties. Three, the remuneration, a challenging word, compensation, maybe easier, to which it is entitled in accordance with the remuneration agreements. And four, the decision maker's exposure to variability of returns from other interests that it holds in the investee. In the first phase of our work in this PIR, some stakeholders said the assessment of whether a decision maker is acting as a principal or an agent can be challenging. In particular, they noted that remuneration, for example, a performance fee, and other interests held by the decision maker can be subject to complex arrangements and depend on future events or performance. In these circumstances, stakeholders find it challenging to assess whether the decision maker's exposure to variable returns is consistent with being an agent. In developing IFRS 10, the board rejected developing a model that would specify a particular level of returns that would have resulted in determining that an agency relationship exists. Instead, the board noted that the more exposure a decision maker has to variable returns from its involvement with an investee, the more likely it is that the decision maker is a principal. So let's look at slide 15, and you see a summary of the questions in this area. And they are about understanding the frequency and the severity. And by severity, I mean significance of the issue. Okay. let's keep going with IFRS 10 and look at the link between power and returns and non-contractual agency relationships. So we've talked about the contract in terms of the contract, but IFRS 10 also notes that a decision maker can act as an agent even without a contractual arrangement. The standard refers to this as a de facto agency relationship. One example of a challenge when assessing de facto agency relationship is illustrated in this slide. There are two entities under common control, subsidiary A and subsidiary B. Each of those two entities holds less than a majority of voting rights, but when combined, they have the majority of voting rights. In this scenario, when assessing control from the perspective of entity A, the question arises if B is acting as a de facto agent of the sister company or if the opposite is true. The board included examples of parties that may act as de facto agent for an investor, but judged it inappropriate to assume that this would always be the case. So if we look at slide 17, we see in relation to this topic that the request for information asks how often an investor is asked to apply the requirements to assess de facto agency relationships, and if there are situations in which it is challenging to apply the requirements. Okay, for the last stretch for me, I'm going to touch on IFRS 10 and investment entities. IFRS 10 provides an exception to the requirement to consolidate subsidiaries for investment entities. An investment entity is required to measure its subsidiaries at fair value with changes recognized in P&L, with the exception of a subsidiary that is not itself an investment entity and whose main purpose and activities are providing services that relate to the investment entity's investment activities. IFRS 10 defines an investment entity as an entity with the purpose of providing investor or investors with investment management services, that commits to invest funds solely for returns from capital appreciation, investment income, or both, and measures and evaluates the performance of substantially all of its investments on a fair value basis. IFRS 10 also identifies the typical characteristics that an investment entity is expected to have, although these are not required characteristics. In the first phase of the review, some stakeholders expressed views that the definition may inappropriately include or, alternatively, inappropriately exclude entities from the category and asked for clarification on some aspects of the definition. For example, in relation to, first, the extent of participation in the active management of the investee that is consistent with an IE status. Second, the level of documentation required to provide evidence that the IE has an exit strategy for its equity and non-financial asset investments. And third, the conditions that need to be fulfilled to demonstrate that fair value information is used for internal reporting and decision-making purposes. Some of the comments were conflicting, which signals that standard setting in this area may be challenging. In defining an investment entity, the board focused on the business model rather than the structure of the entity. So if we look at the question in this area, the RFI is seeking to, is asking if the definition and additional questions are effective in identifying investment entities. Okay, I now am, I think, ready to turn over to Zen for slide 20.
Thank you. Yeah, thank you, Michelle and Mary. I will move on with another matter we heard in the first phase related to accounting for an investment entity or its subsidiaries that are investment entities themselves at fair value through profit or loss. In the structure shown on the slide, the Consolidated Financial Statements will report the fair value of operating subsidiary B but the fair value of operating subsidiary C is subsumed in the fair value of investment entity subsidiary A. Some stakeholders said that the requirement to measure the investment in investment entity subsidiaries at fair value through profit loss results in loss of information on investments held and other assets and liabilities of the investment entity subsidiary. When it created the exception from consolidation for investment entities, the board decided that fair value is the most relevant information about an investment in a subsidiary held by an investment entity, except for subsidiaries that provide only investment-related services. Some respondents questioned this proposal and suggested that at least some investment entity subsidiaries should be consolidated. However, the board did not identify a conceptual basis or a practical way to distinguish between different types of subsidiaries that are investment entities. Let's go to slide 21 for the question. The IFRS is trying to get more information about whether there is an issue with loss of information from use of fair value through profit loss, or if there are additional criteria that may be useful to identify investment entities that should be consolidated. Let's move on still in the IFRS 10. The next two questions in the IFRS address the accounting requirements of IFRS 10. Firstly, they say that IFRS standards should provide greater detail on how to account for events that may alter the relationship between an investor and an investee, such as a party holding significant influence acquires control, or when a parent loses control of a subsidiary but retains an interest in a joint operation. IFRS standards address how to account for some, but not all of these changes in the relationship. Next, some stakeholders disagreed with the requirement to remeasure a retained interest, for example, an investment in an associate, at fair value after control is lost. These stakeholders take the view that remeasuring the retained interest is inappropriate because considered in isolation, the retained interest has not changed. The board revised the requirement to remeasure the investment retained in a former subsidiary as part of the business combination project in 2008. The board decided remeasurement at fair value at the date when control is lost is appropriate because the loss of control is a significant economic event. Measuring the retained investment at fair value is consistent with the view that the new investor-investee relationship differs from the former parent-subsidiary relationship. Let's move on to the question under this topic. The IFRS is asking two sets of questions to understand the frequency of change in ownership that are not addressed by IFRS standards, and what are the current practices for this transaction, and for information regarding the relevance of fair value information on loss of control. Now let's go to the last matter covered by IFRS 10. Some stakeholders asked for guidance about how an investor should account for the transaction shown in the slide. In the fact pattern, a party acquires control of a subsidiary that does not constitute a business, but does not purchase the totality of shares. In particular, the question is whether the acquirer should recognize a non-controlling interest. Again, the request for information is asking how frequently these transactions occur and what the current accounting practice is to help the board assess whether to address this issue in the next step of the review. Okay, we finished the matters under IFRS 10. Let's move on to IFRS 11 and consider feedback we have received and the information the board is requesting. The first matter under IFRS 11 is collaborative arrangements outside the scope of IFRS 11. Some stakeholders noted that there are types of collaborative arrangements that do not qualify as joint arrangements as defined in IFRS 11, because of a lack of joint control. These stakeholders have suggested developing requirements for these types of arrangements. For example, in the left-hand side of the slide, 4 parties reach an agreement to establish an arrangement when each of them has 20% of ownership. According to the agreement, some of the activities could be determined by A, B, and C, and other activities could be determined by another group of parties, for example, B, C, and D. As a result, it is challenging to identify a single combination of parties that controls the arrangement jointly. Thus, this arrangement is outside the scope of IFRS 11, which requires presence of joint control. These parties may apply the equity method in IAS 28 because each of them might be able to exercise significant influence over the arrangement. However, the stakeholders believe that accounting outcomes similar to those for joint operations would more faithfully represent the economics of the arrangement. Let's move on to the slide for the question under this topic. Like other questions, the board is first seeking to understand how frequently these arrangements arise, and secondly, what the current accounting practice is for these arrangements. The second matter we are going to examine is classifying joint arrangements. IFRS 11 established principles for financial reporting by entities that have an interest in arrangements that are controlled jointly. An investor that is party to a joint arrangement determines whether the arrangement is a joint venture or a joint operation by assessing the rights and obligations of the parties to the arrangement. An entity considers several factors when classifying a joint arrangement. First is whether the arrangement is structured through a separate vehicle, and if yes, the legal form of the separate vehicle, and the contractual terms of the arrangement. When contractual terms do not specify that the parties have rights to the assets and obligations for the liabilities, the standard requires an entity to consider other facts and circumstances. Some stakeholders said classifying joint arrangements as either joint operations or joint ventures can require significant judgment in some circumstances, which they believe can be burdensome. In the view of these stakeholders, the requirements in IFRS 11 regarding the classification of joint arrangements should be simpler to apply. Slide number 30 is a question in the request for information. So in relation to this topic, the board is requesting information regarding how frequently an investor is asked to consider other facts and circumstances to classify an arrangement. There are additional factors that may be relevant for the assessment. Now, let's continue with the third and the last matter in IFRS 11, accounting requirements for joint operations. We received some feedback in the first phase about cases joint operators are committed to buying a share of output that differs from the share of ownership in the joint operation. Some questions have been addressed by the IFRS Interpretations Committee, which has published a number of agendas on accounting for interest in joint operations. For example, as you can find in the left-hand side of the slide, Party A and Party B jointly control the joint operation with particular types of products and sell all of these products to their joint operators. The percentage of products sold to Party A and Party B is not always the same as the effective percentage of their ownership. Therefore, under this type of situation, stakeholders ask for the basis on which a operator determines its share of jointly held assets and jointly incurred liabilities. And secondly, how an entity accounts for a difference between the amount of assets and liabilities initially recognized and the equity that was contributed initially. The interpretation noted the importance of understanding why a joint operator's share of output purchase differs from ownership interest in our joint operation in determining the appropriate account required by IFRS 11. So here are the questions for this matter. So the IFI is asking if there are situations in which a requirement in relation to accounting for joint operations does not result in information that is or faithful, and the reason why. Okay, we covered 10 and 11. Now let's move on to the matters on IFRS 12. IFRS 10 and 11, we received less feedback on IFRS 12 and only a few. Some stakeholders asked for additional information, including disclosure of a composition of non-controlling interests, such as to which subsidiary the interest related to. They asked for disclosure of a proportionate share of operating cash flows attributable to material interests, and also information on restrictions on paying dividends, dividend traps, the tax consequences of distribution, and the subordination of debt in subsidiaries. And some stakeholders also asked disclosure with greater disaggregation of assets and liabilities held by subsidiaries with material non-controlling interests or by associates and joint ventures. In contrast, other stakeholders found some of the requirements in IFRS 12. For example, some questioned the need to provide information about subsidiary with significant non-controlling interests because they believe that the group controls assets and is responsible for the liabilities. Some stakeholders noted challenges in applying the disclosure requirements. For example, how to identify structured entities and obtaining information needed for disclosure. For example, when the financial year end of an investor is different from the financial year end of its associate. So let's move on to the question under IFRS 12. In relation to IFRS 12, the board is asking if there are disclosure requirements that the stakeholders would suggest adding, of course, to provide useful information, or removing because provide necessary information in IFRS 12. Now, these are all the matters we are trying to examine further in the request information under IFRS 10, 11, and 12. And we also asked the last question in the request for information to offer an opportunity to our stakeholders to raise any other matters that they believe the board needs to look at. Thank you. Now I'll go back to Michelle.
So thank you very much, Mary, and particularly thank you, Mary, for standing in because it looks like our IT gremlins are still around and Filippo was unable to join us. Hopefully Filippo is here now and we'll be able to take some of the questions. So I think that was a very helpful overview. And perhaps before we move on to discussing the questions that have been raised, I might just review what will happen in the next steps of the post-implementation review. So the comment period now is open and it closes at the beginning of May, the 10th of May. And in that time, the project team will be undertaking outreach activities and discussing the issues in the request for information with the board's consultation groups, with meetings with stakeholders, including investors. And if you are interested in holding an outreach event, please do contact one of the team members and we will try to arrange that with you. The team is also available if you've got any questions on the request for information. So when we drafted the questions in the request for information, we were challenged to balance the request with additional guidance with the board's decisions in developing the standards that the use of judgment in determining if an investor controls an investee is necessary and appropriate. And for that reason, the board is asking the questions that address the pervasiveness of the issues and asking for specific details, including identifying any challenges and suggesting any additional support the board could provide to support application of the standards. We recognise that you may have questions on the information the board is aiming to receive, and so we would be very pleased to help you. I did mention at the beginning of the webinar that if you are holding outreach events or outreach activities, then we can make the slides from today's webinar available to you in PowerPoint form. You just need to contact one of the members of the team and we can make those slides available to you. So let's move on to some of the questions that we have received. And I'm going to ask Mary to rejoin us initially and I'm going to ask Mary the first question, which I think follows on to what I was just saying about most of the questions in the request for information about the frequency and challenges in applying the standards and the extent to which applying the standards provides investors with the information they need. Now the question here is about the role of the standard setter and the access to the information. Mary, would you like to respond to that question?
Sure, Michelle. Just this is the information that we think will be helpful to us in terms of assessing priority, usefulness of, let's say, additional guidance, clarifying amendments, etc., versus the so that's what the questions are about. In some cases, you as national standard setters may have the information to hand, but if you don't, we, especially in these times, we understand that it's hard to engage with a lot of people, but what we wanted to do is to highlight for you why we are looking for that information. And so hopefully you can encourage some of your, if you don't have the information, you can encourage some of your stakeholders who might have that information to respond, because we're trying to say up front what information will help us in the assessments that the first phase of the RFI has identified that we'll have to make. Michelle, that was a bit wandering, but I think that's responsive to the what do you do if you don't have the information to hand question.
Yes, I think that's right. I think it's going to be about talking to the regulators in your jurisdiction and, reaching out to those people that you would normally engage with. Certainly, we have ourselves, used a lot of Teams and Zooms meetings to reach out to stakeholders in these events, in these conditions. Hopefully, Filippo is able to talk to us. Are you able to respond, Filippo? Okay, well, it sounds not. So one of the questions that we have been asked in the post-implementation review is about the relationship with this project, the post-implementation review, and the matters that are included in IS 28. So the post-implementation, does the post-implementation review address the interaction between IFRS 10, 11, 12 and IS 28? And Mary, would you like to respond to that question?
Michelle, I'm sorry. I can't just right this moment. Can you give me another minute?
Well, let me give
I'm
it
sorry.
you, because let me just answer that question. So we have just started the project on the equity method. So I think just before Christmas, the board took from the research pipeline and put it onto the main agenda a project on the equity method. So at this stage, the board is undertaking that project. That project's going to do some research initially on the application problems, and then we're going to start looking at the principles. So we're not in this project, in this post-implementation review, looking at the interaction between those two standards, but we are. The board has got an alternative project. So that is where we are. I think
Michelle,
I had a question about. Sorry, Mary?
No, I was just going to say thanks for jumping in on that. I'm sorry, it's the tumult of COVID-19 and brings unexpected people to your door. I wanted to add to that just again a personal observation, which is I know it's hard having a package as big as IFRS 10, 11, and 12 all together in a single post-implementation review. And that's why I'm glad that we are looking at IS 28 and the equity method in a separate project rather than as part of this. But I'm hoping that at least most of the people on the call will agree that there's such a degree of interaction between 10, 11, and 12 that we really did have to do them as a package for a post-implementation review rather than trying to split them up and do them in a staggered way.
Thank you. We have a question about obtaining copies of the slides. So we will share Jen's email with you. And just so you know, Jen is coordinating this next phase of the project and the outreach activities. So we'll share Jen's email address with you, and then you can contact Jen. Mary, one of the questions that we have had in some of the previous discussions we've had is about IFRS 11 eliminating the use of proportionate consolidation. And that was commonly used in some jurisdictions before IFRS 11 and thought to provide relevant information. Do you think the board will go back to discussing proportionate consolidation in the context of this PIR?
Okay, let me start with a big picture answer and then a specific response to your question. The big picture answer is that the PIR, as I said at the beginning, my shorthand, did expected equal actual, did actual equal expected. And I say that as a positive about what it's supposed to do, because one of the things we don't want to do is to have a PIR be an entire redeliberation of everything that was considered in the original standard setting project. So against that background, I think, as you noted in the question, Michelle, that we didn't hear a lot about it in the first phase about proportionate consolidation, and that's why there's nothing specific in the RFI about that question. Certainly, this is something that we hear about kind of anecdotally, chats, etc. We're not trying, believe me, not trying to drum up business for looking again at this. And I think the focus has got to be, if it is raised, on what information is useful to users of financial statements. So, Michelle, thanks for letting me extemporize there.
Thank you very much. We have a question here which says, please kindly organise a webinar on outreach activities that regulators can comment on. And let me explain. In fact, Jen and I were discussing this point this morning. We recognise that in a post-implementation review, the feedback from regulators is going to be very important to us, because they're going to be the people that have been helping with the consistent application of the standard. Mary, do you want to comment on our outreach activities with regulators?
Sure, Michelle. IOSCO, the International Organization of Securities Commissions, has a standing committee, Committee 1, I like the fact that it's number 1, on issuer accounting and disclosure, and that's big picture disclosure, not just footnote disclosure. We have a regular liaison with that committee and its accounting subcommittee about all of our agenda, including the PIR, and so we will do outreach with regulators at an international level via that committee, as in addition to, I think we will probably be talking to at least a couple of regional groupings of regulators. So when all regulators come together, and we have been giving them the heads up that this PIR is coming, so that they can start thinking about what information they can collect from their experience. I expect, I don't know, but I expect that IOSCO's Committee 1 probably will do formal response to the PIR. Michelle, is that the kind of information you were looking for?
Yeah, I think it's good to know that, that we're in regular contact with the regulators. And I see we have a question from Denise, who used to work at the ISB with us, but has moved to the new UK endorsement board. And Denise is asking and notes that some of the issues that are in the PIR have previously been addressed by the IFRS Interpretations Committee, and so some of them have been agenda rejections issued, or as I guess we don't really call them agenda decisions. And Denise is asking if we might reopen those decisions. And I guess that might be useful just to talk as well, Mary, about what we see as the next steps once we've collated all the feedback to the PIR.
Sure. It's not impossible for us to reconsider something, but this is kind of relates to the point I was making before about it is not our objective to redeliberate everything in the standards. So I think, as I said when I was answering the other question, the question about proportionate consolidation, that really I think the most useful information about issues like that is something not represented faithfully. What have we identified as user information needs that are not being satisfied by virtue of the decision that's reflected in the standard itself?
Thank you very much. I think we're coming to the end of our time, but I just want to touch base with Jen and see if Jen has any comments he'd like to add and any thoughts on the next stages of the post-implementation review.
Thank you, Michelle. I just want to say that thank you very much, everybody, and please feel free to drop me a message if you have any question on the request for information or any outreach request to do with us or on your own, whatever it is. Thank you.
Yeah.
Thank you. And
Michelle,
Mary, I'd like to. Sorry.
No. Go ahead.
So, Mary, I want to thank you for standing in with our IT gremlins today, and just to see whether you have any final comments to add as well.
I do, because I want to say thanks so much to people who stuck with us and came back a week later to get this session. We really appreciate your patience. You can see, even with a super IT team and generally pretty positive experiences, things do happen. And we appreciate your patience. A recording of this will be available for those who are not able to make the rescheduled time. But I just want to go back and say, today, this isn't really an outreach event. We thought it would be helpful because it is, to me, the RFI itself is a pretty dense and intimidating document, despite the wonderful work of the staff to make it as clear and approachable and digestible as possible. And so we thought that it would be helpful to walk through the reminder of what a post-implementation review is in general, to remind people about the background for this project, and hopefully make it easier for you to both think about your own response and also to inform and engage with stakeholders in your jurisdiction about this process, about this consultation, so that we can get as good response as possible, because it is a major section of our existing standards, and we want it to be a robust and thoughtful post-implementation review. So thanks very much for coming along today, spending time to dive into what's behind some of the questions in the RFI, and thanks in advance for your responses and outreach efforts. We appreciate your time. Michelle, back over to you.
Yeah, so thank you very much, Mary. And we were quite challenged when we drafted the document to be specific in what the questions and to articulate clearly the feedback we'd heard in the first phase, whilst making the document readable. So that was important to us, but I have to say, I think my team did a great job in the end, because, they've worked really hard. So I'm just going to wind up the webinar now and say, as Mary said, thank you all for joining us today and for your patience. I also want to say thank you again to Mary, and thank you to Filippo. It's really unfortunate that we weren't able to hear from Filippo, because he's led the first phase of the project and he put the whole webinar together. So I'm sure he's really disappointed, but we thank you for your efforts. And then thank you for Jen and Wendy, who have been in the background, and Jen has stood in for Filippo as well. So with that, thank you for joining us, and please, as we said, do get in contact with us on any of the questions you might have on the request for information, or if you'd like us to work with you on any of the outreach events going forward. Thank you, and we look forward to working with you in the next phase of the project. Goodbye.
Thank you. Bye-bye.